Asset-based lending is different from bank lending. It may be an institution that is not necessarily a bank. And as the name implies, the asset that serves as collateral to back the lending is either, in most cases, accounts receivable or inventory. So accounts receivable, money you owe through clients, you expect to collect that within a year, which is why accounts receivable is a current asset. Inventory you expect to sell within a year, collect the cash, it's a current asset. So the asset that it's backing the loan, if it's accounts receivable or inventory, is a current asset. So that's one thing to keep in mind. And there's going to be two variables for this lending when it comes to the person who's assessing your credit quality. The first is the collateral. How much accounts receivable and inventory do you have on the balance sheet? And the secondary is your financial performance. Do you have consistent sales and earnings? And the reason that asset-based lending is something that companies consider is that some companies just don't generate consistent earnings and sales because of fluctuations within their industry. Their business is seasonal. Competitors come in and out of the market. It's difficult for many companies to create a consistent increase in sales and earnings. So because they can't do that, they need more security for the lender, and so they loan based on their accounts receivable and inventory balances. So moving on from that, let's say, for example, that you have $1 billion balance in AR, accounts receivable, and you have a $2.5 billion balance in inventory. Well, asset-based lending may mean you get a bigger percentage of the asset as a loan. So let's say that under asset-based lending, you get 80% of the account receivable balance to borrow. A bank, on the other hand, may only loan 65% of the accounts receivable balance as a loan. Difference being, the bank has a higher risk tolerance than the asset-based lender. Same thing could be true of inventory. You're going to be able to borrow a bigger percentage of the inventory balance with an asset-based loan than you would in a traditional bank loan. That's the difference there. So the trade-off, what's the trade-off? The trade-off is with asset-based lending, you're going to pay higher interest rates than a bank. And you're also going to have probably stricter covenants and requirements in the bank loan. So a loan covenant in a traditional bank loan is there are metrics that you have to maintain, like debt to equity. Those requirements are going to be higher for an asset-based loan. So that's the difference between an asset-based loan and a commercial loan in a bank.